Hello and welcome to Market Domination Overtime. Stocks are closing the day higher, and our very own Ines Ferre is standing by with the latest market action. Ines.
Yeah, Jared, and green across the board when it comes to the major averages today. The Dow ending up about 0.4%. The NASDAQ is really the big winner, up 1.3%. And the S&P 500 up about 0.9%. I'm just going to pull up a 5-day chart so you can see the S&P 500 eking out a gain for the past 5 days. Also, the NASDAQ as well, eking out a gain as well, up about 0.5% over the last 5 days. The only one that's not is really the Dow that's been that's red for the week. Taking a look under the hood when it comes to the sector action, we're seeing that today technology was leading and industrials, healthcare also gaining. Healthcare names got bumped today after a deal was announced with President Trump to bring down the cost of some drugs of some 9 companies. So we saw some in that space going higher. But also taking a look at the NASDAQ 100, we are seeing NVIDIA up 4% for the day. I'm going to pull up a 5-day chart because, look, it was a bit of a volatile week over the last 5 days, and NVIDIA up for the week more than 3%. Meta also higher. Tesla's higher. Microsoft as well. But you're seeing Apple and Alphabet that are slightly lower for the week. Broadcom down 5%. I'm going to pull up the semis chart so you can see. Staying on that 5-day chart, you can see, look at Micron up 10%. Those blowout earnings that Micron had really helped lift the sector up yesterday and today. And then taking a look at crypto, we have been seeing some volatility with crypto this week, but Bitcoin today able to hold up above 87,000 per token. We have seen tight trading range over the last couple of days, or not being able to maintain 86, 87, 88, but today it is up over the last 24 hours. ETH also up more than 5%. And we also saw that the crypto-related stocks, those got a bump as well over on a 5-day chart. Not so much. It's been volatile for the crypto space in general. Jared?
Yeah, thank you, Ines. And with the gains today, stocks ending the final full week of trading of 2025 on an upbeat note. And my next guest says that with the action this week, the market is primed for a Santa Claus rally. And joining me now is Michael Arone, Chief Investment Strategist at State Street Investment Management. Michael, I'm glad we're leading off on this. This is perfect because last night I was at a CMT event, that's Chartered Market Technicians, a bunch of chart guys, arguably chart nerds like me, kind of hanging out. And guess who was there? Jeff Hirsch, who runs the Stock Traders Almanac. It was his father who in 1972 discovered or kind of invented the Santa Claus rally. It's the last 5 trading days of the year plus the first 2 of the new year. So we're starting December 24th next week. If we get a rally, it's an indicator meaning that the rest of the year tends to do all right. So what are you expecting for the next week?
So I do think that we cleared a couple obstacles this week, Jared, and that both the employment report and the inflation report were tolerable for investors. So I think Santa is certainly warming up the sleigh and hitching up the reindeer. And I expect that Santa Claus rally and the good cheer will continue next week. I think most of the potential obstacles, I'd say all of the potential obstacles, have been addressed and likely removed. You put in the fact that you have an environment that's pretty good for risk taking and a year that's now going to be the 3rd consecutive year of above average gains. And I expect the Santa Claus rally to happen. And next year, we're set up to have another good year in the stock market.
I'm glad you brought up that 3rd year of gains because a lot of people pointed out that according to history, you don't always see gains in the 3rd year after you've seen 2 great years. And nevertheless, S&P up more than 15%. I want to talk to you about your outlook for 2026, though. I see here you're uncomfortably bullish for 2026. And this kind of matches a vibe at the CMT event that I was at last night. There were people on both sides, very credible arguments for bulls and bears, both of them at the end of 2026. So what makes you a little bit nervous here?
So I think for me, I'm keeping an eye on the fact that long-term interest rates continue to be perhaps a bit higher and more volatile than the market's expecting. And of course, now we have 10-year JGBs, Japanese long-term interest rates above 2%. Yes. We have long-term German bonds actually approaching 3%. And 10-year treasuries here in the U.S. continue to be kind of in the 415, 420 range, despite the fact that, at least here anyway, the Federal Reserve has been cutting rates. So that's an unusual outcome, that the Fed has cut rates by 175 basis points or 1.75% during this rate cutting cycle, and yet 10-year Treasury yields are up. So I think for me, the arbiter of this bull market rally, Jared, is likely higher interest rates. So we need to stay range bound. If we kind of start accelerating too much, I think that could cause some problems for this bull market, but it's not in our forecast. As you said, we're uncomfortably bullish. But I think that's the key barometer here, is higher interest rates could be a risk to this rally.
And let's talk about the AI trade, because the last 3 years have been built on the back of AI and tech writ large, but we have seen a lot of rotation over the last year. And that's a healthy thing in a bull market. They say rotation is the lifeblood of bull markets. So what do you see in terms of tech and then maybe some of the other sectors going into next year?
So we still like technology broadly. This is where the earnings growth is. The fundamentals are outstanding in terms of return on invested capital, free cash flow margins, earnings growth. So we still are strong believers in the AI phenomenon. I think we'll continue to see the CapEx there. We'll continue to see consumers and businesses adopt AI kind of continually more effectively. And I think we'll probably find kind of more kind of unique solutions in that area. So we wouldn't abandon tech. The challenge is that most investors own a lot of it already.
Yes.
And so we think that there's some kind of, all this talk of a bubble suggests to me that there really isn't likely a bubble. But Jared, we do think that some rotation is likely. And I can buy two parts of the market that will have similar earnings growth to technology, yet trade at a far lower multiple.
Go for it, tell us.
And that would be financials and small cap stocks.
Oh, I'm glad you mentioned small caps, because I was talking to a guest earlier about this, and he couldn't deny that there's a lot of value that has yet to be unlocked there. Nevertheless, you look at a chart of the Russell 2000 over the last 4 years, there have been a series of rug pulls near the highs, and I can't help but think with this latest break to new highs that's kind of pulled back, are we setting up for more disappointment in 2026?
So I think that's a logical question, Jared. It's going to be 9 consecutive calendar years where small cap underperforms large cap.
Wow.
So skepticism is prudent at this point. But I think the key ingredient here is that earnings growth next year for small cap off of a lower level is expected to outpace large cap. And in fact, Jared, we did get a glimpse of this in the third quarter. For the first time in 13 earnings seasons, small cap stocks actually had higher earnings growth than large cap stocks. And so if this were to continue and be a bit more persistent, we think that this gives a fighting chance for small cap to break that unusually long streak. Not to mention they have a trilogy of tailwinds behind them. That would be lower interest rates, which should help their interest expense and their cost of capital, the end of quantitative tightening and the expansion of the Fed's balance sheet, and then finally the One Big Beautiful Bill Act. All three of those should help small cap stocks. And ultimately, I do believe that the key ingredient here is that their earnings will finally grow faster than large cap stocks. If that happens, I think small caps will have a good year in 2026.
It's all about earnings and interest rates. We got time for one more, so I'll give you the floor. Any final words for investors here in 2025?
Well, from my perspective, I think that the skepticism that continues is healthy for this bull market. And my view is that ultimately, you had mentioned in the previous segment, we're going to get more than $400 billion in fiscal stimulus from the One Big Beautiful Bill Act.
Yes.
We're likely to get continued stimulus from the Federal Reserve and easier rates. And earnings growth has been outstanding and is expected to have double digits earnings growth again next year. It's hard to envision a recession or a bear market under those conditions. So despite some of the skepticism of the potential longevity of this rally, I remain uncomfortably bullish.
All right, those are some compelling arguments there, and we will be listening for Santa's sleigh bells next week. Really appreciate you stopping by here, Michael.
Thanks, Jared.
And President Trump announcing deals earlier with 9 more drug makers as part of his effort to lower pharmaceutical prices. In exchange for the lowered prices, the companies will get a 3-year grace period from tariffs as long as they invest more in U.S. manufacturing. Among the companies involved in today's announcement, GSK, Amgen, Merck, Novartis, Sanofi, Bristol-Myers Squibb. Full terms of the deals haven't been released yet, so it's not clear how impactful the pricing moves will be. But one standout, Bristol-Myers Squibb will offer its blockbuster blood thinner, Equilis, to Medicaid for free. It also brings the total number of companies announcing deals with the administration up to 14 from the 17 originally called out by the White House. President Trump and Commerce Secretary Lutnick suggested the remaining deals with Johnson & Johnson, Regeneron, and AbbVie will be unveiled in coming weeks. And coming up, the CEO of Appian shares his 5 key AI predictions for 2026 next on Market Domination Overtime. U.S. home sales climbed for a third straight month, and here with the latest updates on housing is Yahoo Finance's Claire Boston. Claire.
Hi, Jared. So that's right. Existing home sales are up for the third straight month. It's a little bit of a green shoots for this really, really stuck housing market. That being said, the month-over-month gain was pretty small. It was only 0.5 percentage point to a seasonally average annual rate of 4.13 million, which is still way below what we've seen in the pre-pandemic period. But what this does tell us is that lower mortgage rates right now are bringing back some buyers into the market, even if the rest of the market is still pretty frozen. The other interesting thing is that we are still on track to hit a 30-year low in home sales this year, unless we have a really big December. So we'll have to see what happens next.
All right. And also, please tell us what the outlook for housing affordability is in 2026. Any relief when we think about some of the biggest constraints keeping many buyers shut out? You were just mentioning interest rates.
Definitely. So there's a tiny bit of good news, and that is that most housing economists expect that 2026 is probably going to be a little bit better. And that's for a couple of reasons. One of them is mortgage rate, which you just mentioned. Most people expect mortgage rates to be in the low 6% range for all of next year. And this year we had a really big period where they were close to 7%, and that just shut down the market. So lower rates will help people. We're also expecting home price appreciation to slow. A lot of economists are saying maybe only 1 to 3% gains next year. And that means that wages have time to kind of catch up. Wage growth recently has been more like 3%. So that means home prices could fall on like what we call a real basis. And that does give some people a chance to get back into the market just a little bit. But, there won't be a big crash in home prices. There's no 2008 or anything like that on the horizon.
Well, good news there. And in some of your recent writing, you described 2 market scenarios. So that's where we're seeing cooling in parts of the Southeast and the Mountain West, while the Northeast and Midwest, they hold firm. So tell us about these regional differences and also how they factor into affordability.
Definitely. Like you said, we have 2 completely different housing markets right now, and a lot of that is a supply story. In those markets that are softer now, like the Southeast, those are the places where we've seen the most building in the past couple years, and that's really helped keep a lid on home prices. But then you have markets like the Northeast, where there really hasn't been that building. They haven't added that many new homes. Demand is still really high. And so as a result, that's pushing up prices. And people I talk to say that that's probably going to continue next year because there's just not really any change in that supply demand story. And, we'll have to see what happens. But if you're looking for a home deal and you're in Texas, it might be a little bit easier for you there.
All right. Thank you for that, Claire.
Thank you.
And AI has been the biggest story of 2025, dominating markets and headlines. Just last week, President Trump signed an executive order to ensure that any AI regulation put in place would be federal and not state-specific. So what is in store for 2026? Our next guest has 5 predictions for us, and joining me now is Matt Calkins. He is the CEO and founder of Appian, a cloud computing and enterprise software company. So Matt, thank you first for joining us here. Let's go through this and start at the top, talking about these federal AI regulations. What do you have there for us?
There's going to be a battle in AI regulation in 2026. It's going to be the federal government against the states, and you saw that in Trump's recent announcement. There's going to be a clash about whether the states are allowed to make regulation and whether the federal government is going to withhold broadband funds or go after them for constitutional violations. That'll be one battle. There's going to be another little battle between Republicans who believe in states' rights and Republicans who believe in presidential authority. So look for that as well. And then finally, there's going to be a battle between European regulators and American AI companies. And that's going to be a sequel to the several battles that major American firms have been fighting with European regulation over the last 5 or 10 years.
And how does that play out among some of the biggest names that we know in AI, whether it's the hyperscalers, OpenAI? Are they going to have a stake or a horse in this race?
Oh, yes, they are. They would prefer not to be regulated. They would like a blank slate in which they can operate at will, and they'd like to deal with very few state level regulations, ideally zero. For that matter, they'd like to not follow European regulation, or not at least the onerous part of it. So yeah, the big AI firms want to be under-regulated.
And your prediction number 2, AI will become valuable at an industrial level. And I think this kind of speaks to the trend that we had this miraculous technology that came out, but how are we going to use it? How is it going to improve our lives? And how is it going to fit into businesses? That's finally becoming a reality.
It's finally going to be a reality. We've gone years with the excitement of the idea of AI. It's the world's greatest science project, but it hasn't really moved the needle inside major organizations. And 2026 is going to be the year. At the same time as the AI technological revolution is, if anything, appearing to slow down a little bit, with the models converging and the power plateauing, at the same time as that happens, you're going to see the most powerful impacts made to big organizations that we've seen in the whole revolution. That's because businesses are figuring out how to make use of AI. You don't put it on the side and ask it to do side jobs. You have to weave it into the most important thing businesses do, which are complex processes involving hundreds of people and hundreds of steps, all working together in great coordination. It's hard to fit AI into that, but when you do, it's going to be really valuable.
Couldn't agree more. The question is when. Got to move on here. Prediction number 3, and I love this one. The best investments will be purpose-specific models like small language models. And small language models abbreviates to SLIM. That's your acronym there, because we talk about the large language models a lot. How are the smaller ones going to upheave things?
I think this is the year we realize AGI is the wrong target. We've been talking about it for years. We were talking about making AI that's as smart as a person, and I think that's just the wrong direction to invest in. You see the success that open models are having, that small models are having. This is the year when public understands that we need practical AI, not experimental theoretical AI. And so there's going to be less investment and less focus on building an AI that's comparable to a person, and more on building AI that can do a specific job really well. You don't need it to do every job. You need it to do the job in front of you. In order to make AI a practical technology that matters in big organizations, it can be a lot more focused than it is today.
Well, I like the notion that that's going to cost potentially a lot less money, and I'm wondering how that's going to affect some of the biggest players like OpenAI and then the Claude maker. How is this going to affect these companies that are just outlaying hundreds of billions of dollars, soon to be trillions?
I think it opens the door for other vendors to become powerful winners in the AI market. You don't have to be a maker of human scale intelligence in AI in order to be a big helper to businesses. You could see specialists in different fields, legal, healthcare, transportation, tuning their own AI models and creating tremendous effect and great value for major organizations without the degree of money outlay, the same capital investment that our largest AI firms have made. This is going to democratize the AI market.
I'd love to see that. Nevertheless, the spending is going to continue, which brings us to prediction number 4. 2026 will be focused on AGI scale, fueled by power, data, and processing.
Yeah, the scale game just doesn't stop, and it's astounding how much money is spent. I liken it to laying the railroads across the nation, or the Eisenhower highway system, or the moonshot. It's an astonishing amount of money, and it's not going to stop because investors are still willing to write big checks. However, I think over time we'll see that there are other great ways to get a return on AI other than creating the next moonshot. So I believe that the returns on that investment are going to be a little smaller than some people are expecting, but there will be continued investment.
And here's another one that I find really interesting. Prediction number 5, the AI winners will have better brand and distribution. And I think about a company like OpenAI. I'm not trying to pick on them here, but they don't have the distribution. They're backed by Microsoft, but Microsoft is exploring other partnerships right now. And you kind of have to own the hardware, and they don't necessarily have that in right now. So how does this fit into your prediction?
I think the balance of power shifts toward those vendors that own the customer, own the eyeballs, have the brand power. I don't think OpenAI has the same kind of top position in that future world. I think they've got great technology, but the difference is narrowing. And if they can't rely on having a major tech advantage, then the battle shifts to a distribution advantage, and being present on the desktop becomes the greatest asset. And then in that case, I would expect other organizations to be even more successful.
Yeah, it almost seems like a commodity race at this point. Well, let me get you out on this. I'll give you the floor. We got time for another one. Anything else you want to predict for 2026 or just add to the conversation?
Well, as a business person, as someone who works in AI, I think this is going to be a thrilling year when we finally get AI to pull a load inside of major organizations. AI has been a thrilling technology, but it has not been a productivity enhancer in the way organizations tackle their major jobs. It's so often a one-off. It helps me write an email. It helps me write a software product. But what it doesn't do is help all of us do a big job together. And when AI becomes a practical part of the way we work, we take it to a new level. The light bulb was invented in about 1840, and it wasn't until 1880 that we lit a street with light bulbs, and it wasn't until 1935 that we lit a stadium. And I think that the AI technology is going to follow a similar course. Right now, it's incredible in small situations and in a lab, but you won't believe what it can do once we connect it to the world's biggest jobs. And that's what's going to start happening in 2026.
Matt, you have given me a lot to think about, so thank you for that. I'm getting out the popcorn. I can't wait to watch this one.
Thanks, Jared.
Time now for What to Watch. We're coming up on a holiday-shortened trading week. The market's closing early on December 24th and will remain closed on Christmas Day. Markets will reopen Friday, December 26th, with normal trading hours. And moving over to the economy, third quarter GDP is coming out on Tuesday. The recent government shutdown delaying the initial report and creating a data gap for the Federal Reserve. Economists forecasting third quarter GDP to come in at 3.2%, signaling that the economy is growing at a solid pace. Strong growth alongside cooling inflation, creating a smoother backdrop for the Federal Reserve's interest rate path in 2026. And taking a look at the consumer, we're going to be getting some fresh data with consumer confidence on Tuesday. That number expected to rise compared to November to 91.7, suggesting that households are feeling a bit more optimistic about the economy, their jobs, and their finances than they did in the prior month. And that is going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But do not go anywhere. On the other side of the break, we have a special look at Berkshire Hathaway and its leader, Warren Buffett. Stay tuned.